Good morning, traders. Chris Buss here with Traders Profit Compass with your morning look at markets for Thursday, January 13th. And if you're new here, please run the video at 1.5x. That'll make the most use of your time, and I don't think you'll miss a thing. Taking a quick look at futures, flat as a pancake. Don't forget this morning on the macro front, we've got producer price index print. That's basically inflation for companies on their input costs. Jobless claims, I think both of those are before the bell. We've got Lael Brainerd talking, I believe, at 9:30. We've got nat gas inventories at 10:30. And then we've got a 30-year bond auction at 1 p.m. We had a 10-year auction yesterday at 1 o'clock, and apparently it went very well. We had a little dip in rates. We'll look at that in a second. And then on the earnings front, really two main companies this morning before the bell. We've got Delta and we've got Taiwan Semi, both kind of bellwethers in their particular sectors. So I think those are going to be important to look at. So let's start off with the dollar. I think it's really important. We've had a big change in the chart. Why? We had been on this uptrend, a series of flags, and yesterday we had a big drop out of this consolidation range where we lost not only this trend line, but also the consolidation range. Why is that important? Well, if we look up here, falling, we've generally got a rising rate environment. I think you'll agree with that. And now we've got a falling dollar to go with it. That should be beneficial to financials, industrials, materials, all the commodities, cyclicals, reopening trades, stuff like that. Remember, globally, for the most part, all your commodities, copper, aluminum, oil, gold, a lot of this stuff is priced in dollars. So when the dollar drops, it takes more dollars to buy copper, etc. So that's going to be should be a tailwind as long as if this is an emerging trend after this break, which it looks pretty darn impulsive. It didn't just kind of limp through. It was a big drop down 0.75%, and that is a lot for a currency. So let's definitely keep an eye on that. And what I'm going to do towards the end of the presentation this morning is show you a bunch of commodity-related stocks. Let's take a quick look at yields. We got a little drop here below 1.75%. I don't think that's any kind of big catastrophe. I think as long as we hold above 1.65, the rising rate theme will be intact. And remember, rising rates are kryptonite to Ponzi's and bubbles and tech in general, higher valuations, etc. So the producer price index this morning may have something to do with that. We'll have to wait and see. And of course, we got the 30-year bond auction at 1 o'clock as well. TLT was up or just down 0.38%. I think the trend is down, but obviously we've had a little bit of rally. If you're looking for the next leg down, I think a break back below 143 will start a process to where we'll go back down and test this 141 area. You break 141, as we've discussed in TLT, then you're going to be coming down to test this lower consolidation range at 139. And then if that were to break, then your target will drop to the bottom of the box at 134, and then the bond vigilantes will be going nuts. VIX has come off. We had that little spike the other day, and they've driven it right back down into the mid 17s. nothing going on with the oscillators, midpoint of the range, not really predictive of anything in particular. Jumping on to our index charts, after we had that initial push yesterday morning, things kind of died very quickly and just kind of oscillated the rest of the day. And so you can look at that two ways. A bears would say, oh, see, I told you it's just a kickback rally and it's stalling here. The bulls are out of gas. The bulls would tell you, oh, we're just consolidating after a nice bounce. So, those narratives, we break out and then the bulls will say, I told you so. It was just a flag, just a bull flag. And, if we get a rejection, the bears will say, I told you it was just a kickback rally. And now we take the next leg down. So time will tell. From a swing trading perspective on the daily time frame, got a few things in the bulls' favor here on SPY. What are they? Well, we're still above 470, and we're still above all the moving averages. So as long as that condition holds, I think the bulls have something to talk about, something to hang their hat on. Yesterday we talked about 470 being really important. Why? Because it's the top end of this $20 trading range between 470 and 450. Here's your 50 EMA down at 464. That's going to be an important level. So for today, as long as it holds 470, bulls still have the tape. So if price drops below 470, then chances are come back to test this support band between 466 and 464 down where the 50 EMA is. And then a more sustained bearish move would open up if price drops below the 50. In my process, that 50 EMA is an important level, and we've got the axiom, nothing good happens under the 50. So those, that 470 is a very important line for the bulls. A more important line is the 50 to hold above that. Now on the upside, as long as 470 holds, the door is open for a move back to 475, and that will be where this trading range started. And a recapture of 475 would open up the door to the top end of the range up towards 478.50, 479. Here it is on the 30-minute chart. You can see we had that initial push up to 472.5, where we had I think I added that line, to be honest with you, yesterday at some point, just to mark the high for the day. So, and then we came back down, took a look below 470, but all that was a little overshoot, and then we filled this opening gap. So, from a technical standpoint, we had a little breakout, and then we had a back test to fill the opening gap. No big surprise or anything dramatic more than just that. And so those other comments I just made about holding 470, you can see that well here on this chart. And as we say often, when you see multiple candles make a run at a specific level and hold, that is your cue that a long position is objective. So we came down to 470, we touched it, we had a look below that was quickly bought up, that's a hold, and then we had 4 or 5 candles in the afternoon that kept going down, tagging 470, and then responsive buyers were there. So definitely we've got buyers at 470. everybody's got charts. We're not the only ones. They see the level. The algos have the level. And so until it breaks, support is support. Until it isn't, I think you can be long against 470. If you get a decisive break below, honor your stops, and you won't get hurt. And there was a funny GIF, those animated GIFs you see that are posted now and then. I thought it was really funny yesterday in the trading room. You got Lucy and Linus, right? Sitting, Peanuts characters, Lucy and Linus sitting at a picnic bench, and obviously Linus is doing something, and working on something. Lucy's sitting next to him, and then Lucy rears back and punches him right in the face, sends him on a 360, and then you see the caption, "Use a fucking stop!" Right? It's just so funny, but it's true. It's true, right? If you use a stop and you honor it, it's very difficult to really get hurt. It's when we ignore those stops that we get into trouble. So if you use a stop and you honor it, the worst thing that's going to happen is, number one, you're going to take a paper cut. And number two, when it reverses, right, you get taken out on your stop, and then it goes the way you thought it was going to go. You say, God damn it, they ran my stops. And then you got to reset and redo it. So that's the frustration. But the mentality that you cannot get in, they're just running my stops. It's going to reverse. It always reverses. As soon as I close my position out, it goes back the other way. Except the day you say that and ignore your stops is the day it runs over, and then the next bar is like, right through the floor. So you've got to honor those stops. Just look at them as part of trading and honor them. And so you may have days where, you take a bunch of paper cuts and it's a crappy day, but you didn't lose a lot of money. So that's the key. Preserve capital is your number one obligation as a trader. So let's look at the Qs. We took the big look below. We've rallied, but still below the 50 EMA. So as far as I'm concerned, you still got to be defensive here. And we've got a pivot point that we laid out yesterday at 390. I want to see that taken out. And very much like SPY, we came up to that level. We got rejected. There was an opening gap here that I've taken off. So we rallied up to 390, backed off, filled that gap, and now we're sitting down towards 387, 386 is support. So you can be long against that level and then look for a move back up to 390. But for my money, I want to shoot long against the 50. I want to see that taken out. And we had several runs at it yesterday, couldn't do it. No energy in the afternoon. You can see here that we just kind of, just waffled around over a very short trading range. So there really wasn't a lot to do. And so I want to see 390 taken out. And if it can do that, you'll know you're above the 50 confidently. And then you can shoot long and see how far the rally can go from there. So that's the way I would play the Qs. IWM, kind of the same idea, except price is wrestling with the 200 here at 218. Made a little run at it, fell back. I don't think you can really try a long. Here's that level where it made a run and then right on the first bar got liquidated and then didn't do anything the rest of the day. And with price below the 200, I think you got to be, it's a bearish setup. I just want to go back to the daily just for a second. Notice the bearish stack that's happening on the EMAs. You got the 50, you got the 20 below the 50, you got the 8 below the 20. They're all steeply pointed down, heading for the 200. And then your full on bear mode is when you've got the 200 on top, then the 50, then the 20, and then the 8, and then you've got that full bearish look on the EMAs. And really, we haven't had that because we've had this choppy trading range for a year. And whenever you have that, you're going to have, the moving averages above and below the 200, and it's kind of hard to get a read. But one thing I've penciled in here is, this looks like a bear flag to me. A quick run down, a little rally within a tight range, building out this flag. You break the flag, chances are you're going to come down and retest this low. And what I still believe, and the chart supports, is that price is going to make another run at 210, which was the low back here. And if you go back for a year, 210 has been an important level on this chart. And just to show you the indicators, bearish regime on momentum, bearish regime on RSI, that's supporting lower prices. And price really hasn't given us any indication that it wants to make a run back up here and try and fill this gap. Now, that may change, but until it does, I think you got to lean bearish on the charts. And then here's for more active traders. Price is sitting on this 216. You get a break of that, you're going to come back down towards this gap at 214, 213, and then you got your prior low down at 211.50. Now, this juncture, what I usually like to do is welcome any new viewers to the channel. Thank you so much for spending time with me this morning. Trader's Profit Compass is a place where you can hang your hat on levels and count on good advice on how to trade around them. And if you're a trader, having confidence in levels is everything. Well, it's half of everything. The other half is execution. So if you like that kind of analysis, hit the subscribe button, hit the alarm bell, hit the post notifications. You'll get notified of my YouTube content. And I want you to know that that's only half of what I do. The other half, you got to go over in the show notes, find the link to the website where you can drop in your email, join the team. That means morning, noon, or night. Anything that I send out goes to your email box right there conveniently for you to open it up and see what's going on, whether it's a trade idea, anything at all, market observation. And I usually am out with something at least a couple of times a day. It may be a video, it may be a short note, but when I have something to say, when I notice something in the charts, I will be sure to let you know. And also you get an invite to the trading room. So I hope you take me up on that invitation. It would be great to have you. Facebook, pretty impulsive move off the lows. Yesterday was a consolidation day. We've got a flag being carved out between 330.5 and 334. You get a breakout of 334. I think you can buy that and look for 340. If it rolls over below 330, then I think you're looking at move back down to 327, potentially 324. I think 324 is your super big important level on the downside. That marked this low, some lows back here, and your last decent volume over price support bar. Once you get below 324, all that support falls away, and then you'd be looking at a back test of this prior low at 316. And if it goes below 316, I don't know what to tell you. The bulls will be in full bear mode, or excuse me, the bears will be in full bear mode. Apple, nothing day yesterday. This looks like a consolidation and potential bull flag. What would get me going on this is a breakout above the flag, above 176 that holds. Then you open up 177.5 and 179. If it rolls out of this flag, you're going to be coming back to this support zone between 173.5 and 172. Tesla had a nice day. Gap up, never looked back. I think you can, it's too late at this point. If you bought that breakout at 1080 yesterday, then stay long with it and look for 1130, and above that you've got 1150 and then 1200. If price comes back to 1080, I would view that as a back test. I have on this chart 1080 as being the most important level in this little range area. So I would stay long against 1080 and be getting cautious if price broke back below that. Microsoft has really one of the, aside from Netflix, one of the weakest charts presently in the FATMAAN complex. Why? Because had a really fast move from 344 down to back test the original breakout at 305, filled a gap down there, and we've put in this rally, but notice where the rally has stalled at these prior lows at 319-ish area, and we're sitting on this gap. And that has carved out to me what looks like a bear flag at this point. Now, what would invalidate that? Well, if it holds 319 and then drives up and drives past 322, that bear flag will be looking long in the tooth and kind of lose that classic bear flag structure. Now, if today or shortly price loses 319 and comes back down, to fill this gap, your gap fill at 315, in my mind, would be the last chance for the bulls. Gaps get filled. We could come down here to 315 and have that hold and, then bounce up, having had this filled as a technical check mark. No unfinished business below, then break out. That's a potential possibility. But if price rolls over and then loses the bottom of the gap, then I would definitely be short against 315 and then look for a move back down towards 305. And just in my experience, very often when you get a dramatic down move like this, you don't just get okay, that's it. Now we go back up to new highs. I think a lot of times what you'll get is that classic W formation. Here's the left side of the W. Here's the middle. Come back down, put in that double bottom, and hopefully see some bullish divergence in the indicators. Then reaccelerate and go back up for the right side of the right side of your W formation. So I would be watching this 319 area like a hawk. Amazon. This structure here tells you how important that 33.15 is at the bottom of the box. Now we have spent the bigger half of 2 days right here pinned below. Looks like a bull flag. Impulsive move off the floor, trade in a tight range, and then price has to prove it right here with a breakout above 33.15 and really preferably above 33.40, because you can see that we've already had a reach up to 33.40 that failed, and you can see that we've got a large volume over price bar in that range acting as resistance while price is below. So I think there's good opportunity there if it breaks out. Why? Because you'd be entering back into the bottom of a $125 box. You get a breakout there, and then your target will be 34.40. Now, here's where your personal preference comes into play. Say this morning you get a little move into 33.25. What are you going to do? Are you going to say to yourself, wow, I broke out from the flag, I'm getting long against 33.15? Or are you going to say, hey, I want to wait to watch price prove it, get above 33.40, then take it? That's personal preference. I can't tell you, they both are right. One is, I'm going to hope to get that second breakout above 33.40. The other is I'm going to wait for price to prove that first before I take a position and, possibly get to avoid the potential of getting stopped out in this area where you have another little fake breakout and then it comes down. And one thing that can influence your trading decision is, what does the rest of FATMAAN look like? What do the Qs look like? If you see Apple making a move, if you see Facebook breaking out, if you see, Google, Tesla, all those names like making moves, and you get a little move above 33.15, maybe that's a good bet, because Amazon will, follow that herd. But if you see a lot of FATMAAN just being choppy and not really doing anything, and then you get a little $5 move out of Amazon, maybe that setup is not as strong as you might think. So a lot of little nuances there on how you might want to trade that. Google, nice little consolidation, looks like a flag, still have the gap below. So you can use the breakout above the flag. You can use 28.40 as a pivot level. If price comes down to fill this gap and holds at 27.85, then you can use that as your entry location on an objective long with a stop just below. Netflix remains in the weeds. I don't want to trade it here. I want to wait for either a kickback rally or come down towards 5.15, where there may be some support. We've got a large volume over price bar there, but right here in the middle, I think it's more of a dart throw than anything else. And honestly, it's been very weak. We had a lot of no bounce. We've got nice bounces in a lot of names, no bounce here at all, so it remains really, really weak. Semiconductors. We talked about the two key ranges yesterday. That's 308.50 and 302.50. I think between there's the potential. I mean, it's a wide tradable range, and the way I've got this drawn, just to interpret it, right here in the middle, tough to take a trade because you're in no man's land. If you get another push up to 308.50 and you see a stall, you can try a short there with a stop just above. If you get a move down and you find stability, that 302.50 holds, then you can try a long and look for a move back up to the top of the box. But right here in the middle, I think that's a tough trade. You're looking for either a breakout above 308.50 or a breakdown below 302.50. But if you're an active, nimble trader, you can make a lot of money between that's a $6 range. So you may get a little pullback here that holds, and then a move back up to 308. That's a nice $6 move, and I think any trader would be pleased about that trade if they got that intraday. That would be a great trade. Now I want to move into the commodity complex. I just want to show you a bunch of charts. This is DBB. This is an ETF for base metals, equal weighted between copper, aluminum, and zinc. You can see here we just had a little breakout here above like 22.50. We're sitting here at 22.83. If you wanted to, you could buy it here, or certainly if you got a little red day, a pullback into that area, you can buy it there. And what you're counting on is, one, for that support to hold, and number two, the dollar to continue moving down. That's going to be very supportive of base metals. Here's the DBC blended commodity complex tracking ETF. You can see the breakdown here. This would be more or less a backdoor way of playing oil. You've got energy being half of the mix, and you've got price right here challenging the top end of the range. Get that breakout there, and then you can buy some 22 calls out in time. The option chain is pretty liquid. You may want to be patient, try and get a good fill depending on what strike you're going for, etc. Nice thing about this is you're not locked in to 100% oil or 100% of any one thing. You've got a nice mix of ag commodities, industrial metals. You even got some gold and silver in there, and you've got a beta of about 1. So that's a nice ETF if you don't want to get into specific names. Our coffee trade continues to work. We've got price above all the moving averages, riding up, challenging this 66 area. And I think if we get a breakout there, then we can go up and test the midpoint of our channel, and hopefully, fingers crossed, make a run back up to the top of the channel. I really like the posture of the PPO here. We've got a momentum reset right to the 0 line, and now we've got a bull cross, and we see that RSI, for the most part, has been in bull mode for the last year. So that's very supportive. Bad weather down in Brazil, hampering the coffee crop. So that's been supportive of higher prices. So I'm going to stick with that trade, at least for now, and see how it goes. Speaking of Brazil, Brazil is a commodity complex country. Often the way it goes is the way of the dollar. When you see dollar strength, Brazil goes down. When you see dollar weakness, it goes up. Now we formed a base down here. We had a really good day yesterday, up 3%. I am not in this trade, but I'm looking at it closely. You've got a $2.50 trading range. So you get a breakout here, 29. That would bring you up to this level here at 31.50. You do have the 200 to contend with, but you're above, you recaptured the 50, and then getting a breakout here would be, I think would be technically important. And if you see dollar weakness continue to persist, I think that's going to be a booster shot for all things Brazil. And I don't have the chart here, but another name you can look at is Vale, Vale, iron ore producer based in Brazil. That chart is really shaping up as well. Here's XME. I bought it here on the breakout, got cold feet back here, sold it, and now it's right back up to where I bought it. So bad trade there. Should have given it some extra time and be a little patient with it. You can see the mix here: steel, aluminum, gold, copper. Still bullish on this whole setup. We've got a essentially a $7 trading range. Get a breakout above 47.50. The measured move would then be 54. I still like the group, still like the trade. Probably going to be back in it here shortly, so I like that. Here are the copper miners. Big breakout yesterday. We've got a $7 trading range here as well. So measured move target is going to be up towards 47. We've got a prior high at 45.5. I like this trade. If you got any kind of weakness today, I think you can buy that and then stay long against 40 with a stop just below. And my approach in these commodity trades is to take a longer view. You know that I'm long that BTU coal name out in April. I'm not worrying about, the volatility day to day. I just want to see a grinding upward trend. And we're starting to see that in that BTU coal name. But these names tend to have more volatility than the average Joe. So, here copper miners, you can look at Freeport-McMoRan, FCX. You can look at Southern Copper, SCCO. You can look at Tech Resources, TECK. Those are all mostly copper miners with some other mix. So that looks good. Here's gold. We've got a gap here between 171 and 172.50. We've got price coming up to challenge that level. Gold has been a frustrating heartbreaker. I mean, all this chop here for months and months and months really hasn't gotten anything going. I will leave it up to you whether you want to try to set an alarm here at 171, get that move, and then see if we can get up to 174, get a breakout, and then go. But we've been saying that for a long, long time, and it hasn't really panned out. So, but certainly worth watching because chop doesn't last forever. Hard trading will eventually become easy trading, and that may start with a breakout here at 171, fill that gap, go up here, break out, and then go back up towards these highs at 179, 180. That would be nice to see. And I'll leave you with the last chart here. ArcelorMittal steel stock. This is the weekly chart breaking out of a long consolidation that is $8 wide. So measured move basis, up in the mid 40s. And what I want you to take note of is the momentum profile, that classic, drift down in momentum during this consolidation. We got a correction in time, not in price. So since last May, this has really done nothing. It's been a nice trade if you buy support at 28, and now you're up at the top of the box. But now you've got a bull cross working on the weekly. You've got a break above 50 on RSI. You got price breaking out. I like that trade. If you can handle a couple dollars of heat on the downside, against 36, this is a nice setup to look for the mid 40s. And there's always multiple ways to look at anything. You could say, why didn't you buy it down here? Well, because I missed it. You can say, oh, well, you missed it here too because the breakout was yesterday or the day before. That's true as well. But look at the glass half full case. We just consolidated since May, and now we're breaking out. And your target is, $8 to $10 higher. So if you can take $2 of heat for $10 of upside, that's a 5 to 1. I mean, I'll take 5 to 1s all day long. And if I get stopped out, I'm wrong. But if I win, then, everybody will be happy. So it's all about risk reward and what you're willing to take and what you're willing to not take. So let's leave it there. This has been Chris Buss with Trader's Profit Compass. I hope you have a really good day of trading, and we'll talk to you next time.